business day. That means we have 55 minutes to go around the world of business, having current and relevant business conversations. I'm Ini John Mekwa, and this is Business Morning. And we start off, as usual, from the global space where oil prices rose on early trade and signs of fall in U.S.-China trade tensions that bolstered market sentiment, alleviating concerns over global fuel demand. U.S. President Donald Trump remains committed to meeting Chinese President Xi Jinping in South Korea this month, according to Treasury Secretary Scott Bessent. And both countries are trying to diffuse tension over tariff threats and export controls. Brent, we see for this morning, is down, slightly down there, I guess. No much movement since we are still waiting for sentiment around the talks. So it dropped 0.01% to $62.88 a barrel, while U.S. West Texas Intermediate crude was at $58.88 a barrel. That's dropped more than 1%. So we know yesterday, from the weekend to yesterday, when all of this new 100% tariff threat from the U.S. to China started, we did see some very dramatic movement around WTI, which is the crude from the United States. So I guess that hasn't really changed. At some point, we saw it overtaking Brent. So that's stabilizing now, and then we see it drop more than 1%. And the prospect of improved trade relations between the world's two largest economies has historically buoyed oil markets as investors anticipate stronger global growth and increased fuel demand. Well, staying in the oil space, let's come here to Nigeria. I'm sure you have seen or noticed the change in the price of petrol here in Nigeria. Is it connected to what's going on in the global oil space or not? There are also reports that price at the depot since last week had increased, depot price of petrol. So let's delve into this now with the Assistant Vice President, Economic Research at Financial Derivatives Company, that's Dr. Ifoma Nwokolo, joining us virtually now. Dr. Nwokolo, good morning and welcome to the program. What's going on? We just see NNPC has increased the price of petrol. Is it connected to what's going on in the global space? Is this a domestic issue?
Good morning, Ini. Thank you for having me. I'll say what is happening currently is connected with the domestic issue. It doesn't have anything to do with global, because if you look at the global oil price, it has declined. It's been on 65 for quite some time, but now it's on $62 per barrel, which implies that we are supposed to see a decline in the price of PMS, but we are seeing the otherwise. So I would say that the direction of the PMS price that we are seeing, if we compare to what it was, it's 841 naira to 992 naira per liter. We have over 100 naira difference. And if you look at other, in fact, we have price disparity. Yes, let me put it that way. There's price disparity, and this could be as a result of the landing costs. NNPC may be having a hike in the landing costs, because if you come to pricing, a lot of things are involved. Before you can determine a price, you'll be looking at your costs of production, your logistic costs, and other factors are put into pricing. But what we are seeing today, looking at actual price and also price direction. Looking at the price direction, it's going upwards. But looking at the actual price, we are seeing price disparity in almost all of the filling stations. Some are selling for $9.92, some are selling for $9.22, some are selling for $9.15. So there is the issue of price disparity. But the question is this landing cost an efficient landing cost? If it's not an efficient landing cost, over time, the market will correct itself, because I know there is always an invisible hand that corrects the market.
So Dr. Nwokolo, we're talking about landing costs. I think that comes into play with the crude, or is it with the refined product? Because we have Dangote here, even though there are numbers showing that we still do a major import of refined petrol.
Yeah, I would say I'm talking about landing cost, because if you look at oil production kept declining. So I guess NNPC imported oil, and if they imported, I think there should be a decline because global oil price is declining. But if we are seeing the direction of the price going the other way, other factors may be included. Look at our exchange rate. Exchange rate depreciated. Of course, they are buying via exchange rates. So all these factors will be included in the pricing. So I think that is why we are seeing this price differential, hike in price. The landing costs, the logistic costs of bringing it back here in Nigeria. Of course, when there's depreciation in a particular currency, your importation becomes more expensive. So I think,
talking about the value, the exchange rate, we've seen Naira slip in the parallel market, lost 0.2%, but it's on the opposite side in the official market. Should we be worried? I think last week also we did record, more gap between the the official market and the parallel market, and it looks like we're going that way again this week. Should we be worried? Do we know the drivers? Can we put an end to it?
Yes, is a reason for concern. I would say if care is not taken, it means we are going down the slippery slope. If cautions are not taken, if you look at the parallel market, the gap between the parallel and official market is over a 50 naira, and this will create room for arbitrage if this is not handled. If you look at the official market, of course, we know the price in the official market is determined by the CBN. But talking of the parallel market is determined by the forces of demand and supply, which is the invisible hands fixes the prices in the parallel market. So if this is not controlled, and why are we seeing all of this? You see that there's pressure in the parallel markets. Yes, more demand, of course, because of speculative reasons. If people are looking at what is happening around, and if you look at last week, the dollar rates via Naira actually appreciated about 40 something, and a lot of people were trading. They saw it as an opportunity to buy. So I think that was why we had that pressure in the official market, coupled with the fact that, yes, if there is liquidity constraint, of course we know if demand pressure persists and we have liquidity frictions. So that is why we see the dollar depreciating, Naira depreciating in the parallel market. And looking at our export earnings, of course, we know that for the past few days, the price of crude oil has continued to depreciate. Price of cocoa is almost half the price. It used to be 12,900 per metric ton, is now falling to about 6,000 per metric, below 5,000, or below 6,000, 5,000 plus per metric tons. And what does that tell you? It simply means that the influx or the exchange rate influx that we get from these foreign earnings are beginning to decline. So mounting pressure on the FX market. So that is what we are seeing happening in that particular space. And something has to be done because a 1% depreciation in the Naira has a knock-on effect on prices of commodity. Also, a 1% increase in the price of PMS has its own knock-on effect on prices of commodities.
All right.
Following the fact that harvest season is almost over. So if we add the high cost of PMS to this, and also the depreciating Naira, I think it's going to weigh on commodities. It's really going to weigh on commodities. And in the future, in the near term, we are going to see prices. Of course, we are beginning to see prices moving upwards. Prices of rice is now 80,000 from 75 last week. The beans is also increased to 80,000. And tomatoes also, this is the season, festive season beginning to increase. So if prices of PMS can increase by over 100 naira per litre, you know what that means on commodity prices.
But in spite of this, Dr. Nwokolo, FDC is projecting a decline in inflation data, which we're expecting tomorrow.
Yeah, that's inflation numbers we are seeing is for September, not for October. We're in the month of October. There's usually a lag. So the projection is for the month of September. And from the look of things, maybe from October, November, December, if things are not addressed, I think inflation is going to revert itself upwards. And when it reverts itself upwards, you know what is the CBN is going to do concerning their decisions.
So what do you mean by things are not done? What do you think can be done?
Pardon?
What do you think can be done? I mean, we're already in October, we're in the ember months. What do you think can be done to reverse it or to sustain the decline trend that we've been seeing for over 5 months now?
I don't think with the development of things now, naira depreciating, hike in petrol price, I don't think we are going to see inflation continue to decline, especially food inflation. Because once prices of PMS increase, of course, it has knock-on effects on logistic costs, knock-on effects on transportation, knock-on effects on prices of commodities, because you have to move those commodities from the farms to the end user or to the market. So you are paying more transporting these commodities. So once you pay more, of course, it's going to weigh on the prices of commodities. And let's not forget, this is ember months. So these factors are going to outweigh the benefits we have gotten from the harvest season. Of course, we saw that food prices actually came down because of harvest season. So this new development will outweigh all of these benefits.
So is this a threat to our dirty December?
Of course, it's going to affect it, prices. And this will drive speculative buying. Yes, historical inflation is a different thing, and inflation expectation is a different thing. What actually spikes inflation the more is inflation expectations. Seeing exchange rates are depreciating and seeing prices of PMS increasing simultaneously, I think people will start buying, panic buying, that they don't know what prices will be in December. Of course, you see, this will also push up prices. The panic buying will also push up prices. So expecting a continuous falling inflation trend in October, November, December may not be visible. That is what we are saying. It may not be visible following all of these trends that are happening recently.
All right, sadly so, Dr. Ifeoma Nwokolo, but thank you so much for sharing the findings of Financial Derivatives Company with us, Assistant Vice President, Economic Research with FDC.
Thank you for having me, Amy.
All right, let's see how the market closed yesterday. It was a positive close, sustaining the 147,000 level, which we hit really early in the trading season or session yesterday, and we went up to 147,717.26, 0.23%, up for the all share, and the market cap at 93.76 trillion naira. Activity was all green. Activity, volume, value, and deals all green. Deals hit more than 31,531. That was a huge activity right there. And top gainers, insurance, Power. I'll tell you about their results in just a bit. But insurance were the two top gainers right there, and top losers, Triple Leg and Deep Cap and Wema Bank. Top trades, insurance again, and Fidelity Bank led that. And talking about Power, yesterday they shared their third quarter results, showing 38% rise in revenue to 308.5 billion naira for the third quarter of this year. So no wonder they had investors' activity around them on the stock market yesterday. And that's up from 223.5 billion last year, driven, they say, by higher power generation and improved efficiency. Profit before tax grew 91.2 billion from 81 0.1 billion. Profit after tax rose 17% to 68.4 billion. Gross profits also went up to 119.7 billion. And the company's leadership says that results show resilience despite economic challenges, while reaffirming commitment to sustaining growth and value creation. And Nigeria's commercial capital, Lagos, played host to English neighbors in the West African sub-region for this year's edition of the West African sub-region. This year's edition of the West African Insurance Companies Association, WAICA, an education conference. The 3-day annual event is holding for the first time in Nigeria and is bringing together industry leaders, regulators, and stakeholders to address the growing impact of climate change on the insurance industry. The conference is also focused on newly enacted Nigeria Insurance Industry Reform Act, NIRA 2025, and its role in strengthening the nation's insurance framework.
Key players and operators in the insurance industry, policymakers, government agencies, and delegates from Ghana, Liberia, Sierra Leone, and the Gambia all gather in Nigeria for this year's edition of the West African Insurance Companies Association Education Conference, WAICA 2025. The event kicks off with an energetic cultural display by the Nigerian National Dance Troupe from 3 major parts of the country to an excited audience. The Commissioner for Insurance, Mr. Olusegun Omosheyin, who declared the event open, highlights the significance of the NIRA Act 2025 signed by President Bola Tinubu on August the 5th, as he states that climate change is not just an environmental issue, but an economic and financial challenge that demands urgent attention from insurers across West Africa.
Present, key provisions of NIRA include a stronger capital base for our operators, expansion of compulsory insurance classes, including agriculture and environmental risks, deeper integration of insurance into public-private partnerships for infrastructure and climate resilience, strengthen public confidence in the insurance industry. These reforms are not merely technical. They are foundational to our national preparedness and long-standing sustainability.
On his part, the president of the WAICA, Solomon Sesay, believes that addressing climate-related risk requires a unified regional approach that blends regulation, innovation, and partnership among governments, private sector players, as well as development institutions.
Over the years, WAICA has provided a platform to enrich our knowledge of insurance, share business information, and network as insurance professionals in the sub-region. It is in furtherance of these noble objectives that we have packaged this conference to address the issue of climate change and how insurance can build resilience across its operations in response to the challenge.
The ongoing 2025 WAICA conference seeks to end with a renewed pledge from industry leaders to integrate climate risk management into insurance operations and build stronger, more adaptive markets across the sub-region.
All right, now let's put our eyes on the revised guideline for agent banking in Nigeria. So from April next year, the first day in April next year, we'll see a lot of changes, but I mean, the road to that has already started, and we're expecting at different points in time there to be differences, changes in the way the POS, operates. So let's see what to expect and perhaps the impact it might have on your operations with them. So let's first of all put our eyes on some of those changes that the Central Bank of Nigeria has introduced or revised in some other places when it comes to agent banking. So we see now that there's mandatory geofencing and geotagging. Fixed location or POS terminals must be geotagged with GPS coordinates and registered to a specific business and a service location. There's also terminals only permitted to operate within a 10-meter radius. That's the geofencing of their registered location. Activity outside the radius will be automatically flagged, and terminals that are not geotagged will be barred from processing payments. This is supposed to start 60 days from the circular's issue, and the circular was issued August 25, 2025. That's for the geotagging, with compliance check commencing this month, October 2025. The central bank also talked about mandatory geofencing, geotagging, that's what I've talked about. And then there's the single principal exclusivity rule. That's POS agents will be restricted to working with only one principal financial institution, a single bank, a mobile money operator, or super agent. So you can't have multiple. Effective date for this is April 2026. That's every agent for one. And then the transaction limits, there are caps now for customer daily limit, cash out, cash in, bill payment is 100,000 naira for one customer. Weekly, 500,000 naira. An agent daily cumulative cash out limit is 1.2 million naira per agent. And of course, we know that all of these conversations started with some illegal robbery, kidnapping connected to POS in some places are being used as a smooth way to cash out money. So that's why the CBN has come up with all of this, and there are stricter eligibility prospect for agents to meet the requirement preceding 12 months and having their BVN not flagged or blacklisted. You know, all of those, that's what we're supposed to be seeing from now on. We have the acting president of the Association of Mobile Money and Bank Agents in Nigeria, AMBAN, Dr. Bioha Oti, joining us to help us understand how they are preparing for all of this. Dr. Oti, good morning and welcome to the program.
Good morning.
Great.
Thank you for having me once again.
Good to have you, Dr. Oti. So let's start from the essence of this. So for us as consumers, we've been told by the CBN that these changes are necessary because of the abuse that's come to that sector, the agent banking sector. I wonder if you agree that these changes are necessary to start with.
Of course, I don't have any problem with the central bank for trying to tackle a lot of abuse that we have in the industry. The last time I was here, I highlighted a lot of abuses, especially in the area of fraud and kidnappers cashing in from
I think we lost Dr. Oti there. Oh, okay. Hello, Dr. Oti, can you hear me? Okay, looks like we lost him there. So, okay, Dr. Oti, can you hear me?
I can hear you, definitely.
Okay, we lost you for a bit. So perhaps if you could tell us what you said again about your thoughts on these revised guidelines by the CBN.
Okay, I said that, yeah, I quite agree with the central bank. It is good to find a way to curb all the malpractices, to make sure you restore order and the regulatory compliance within the industry. That's very good. But I have quite a number of reservations also on how the rules will apply, especially as it has to do with this particular new circular that was released on the 6th of October.
Do you want to specify that part, please?
Yes, basically nothing much is new in this circular. I think right from the first time we saw the agent banking policy, I think even my association, AMBAN, contributed to reviewing the draft policy as at the time it was sent to us some years back. Though this recent one, we were not, it wasn't sent to us. So nothing much changed, but a few things were introduced. The idea of exclusivity has been there, though not being enforced. Then the limits for transactions has been there, but from time to time the CBN tries to tweak it. Then the sanctions also have been there and all that. But I want to highlight on some of these emphasis on this particular circular as it has to do with agent banking. I appreciate the central bank for doing everything they can in order to curb malpractices within the industry, deal with fraudsters, deal with certain elements that want to abuse the system. That's fine. However, you will agree with me that in the world now, a lot of regulation, by the time you introduce too many regulations, you stifle innovation. One of the promises by Donald Trump, the current American president, during his election was that he wants to reduce regulation as much as possible in order to encourage innovation and entrepreneurship. So, but this year alone, the central bank has consistently been releasing guidelines, policies, and directives, especially as it has to do with agent banking. But my point is, in as much as this is okay, there is a reason behind it. They really want to deal with the bad eggs and all that. But they equally have to bear in mind that they are stifling the entrepreneurship part of it, the innovation part of it, and above all, the ultimate aim of deepening financial inclusion and improving the quality of life of the average Nigerian. So by that, I mean that the central bank now has to engage more. You know, there has to be more conversation, especially with the people that are directly affected by some of these policies, guidelines, and directives, in order to find a more appropriate and practical way in order to make sure that there is balance in between trying to regulate and curb malpractices, and also to make sure that the people you are intending to serve does not suffer unnecessarily.
So, Dr. Ozzy, do you see a situation where, because you talked about the threats to financial inclusion there with some of these guidelines, do you see a situation where that is threatened? Perhaps is it because of the 10-meter radius or the exclusivity? Which of them? And I know also there's also one of the guidelines that says that then POS agents now would have to display their services, have a shop where it's branded and all of that. We know that a lot of the POS agents do not do that. So do you see these as a threat to the financial inclusion and deepening of this financial inclusion that we've been working on?
Okay, I'm going to particularly talk about three things. The first one is the idea of geotagging. Then the second one I'm going to talk about is exclusivity. Then finally, I'll talk about non-permissible activities. Now, let's start from the idea of geotagging. Geotagging is fine. The last time I was here, I emphasized that it is going to help particularly the law enforcement agencies to be able to identify criminal elements that cash out from agent locations, because it's going to pinpoint exactly where this transaction is done on a particular location on the map. So that's very fine. However, we need to understand that our country still has a lot of rural communities. So you will not just adopt rules and regulations that apply in very highly developed cities and expect that it will work 100% in rural communities. For instance, I emphasize about the idea of market days. a lot of villages in the country, they don't have one particular market days, and that make a typical agent a roving entrepreneur. So on a particular market in a particular city, you go there with your POS terminal, do your transactions. The next other market day, you go to that place. I equally identified drivers that use the POS as a means of collecting their fares. Okay. Now, if a particular POS is geotagged to work only within 10-meter radius of a particular location, all this will not apply. Okay, now, another thing that will have made it a bit more flexible for agents to be able to operate in multiple locations will have been the idea of exclusivity. For instance, if you can collect POS from one principal and then geotag it on a particular location, then collect from another principal and geotag on another different location. So you now have the flexibility to be able to collect from as many principals as possible. Now, there is exclusivity rule, which invalidates that. Okay. Now, exclusivity is fine in certain areas, but generally, it is like introducing monopoly into the system. And you and I know that monopoly restricts the freedom of choice within the market. Now, let's look at a typical agent. In as much as a typical agent is an agent to a principal, and the central bank views an agent as an unlicensed entity that is operating through a licensed entity, that is fine. But we equally need to understand that an agent is an entrepreneur, and an entrepreneur has to be innovative and has to ensure that his business is profitable before even venturing into that business. And if the business is not profitable, the entrepreneur cannot ultimately continue that business. So regulation is fine, but the idea of entrepreneurship should not be less emphasized. Now, when this circular came out, we within our association, we've tried our best to enlighten our people, try to enlighten members of the public, and especially people that are concerned about one idea of it or the other. But generally, I have seen a lot of agents who are thinking of quitting the business because of what they think is going to happen as a result of especially exclusivity. For instance, now, if a particular agent is tied to just one principal at a time, some of the principals, especially the large ones that are well established in the market, can become exploitative. And these are the attributes of a typical monopoly. Okay? And one of the reasons why agents try as much as possible to patronize different principals is because there are different gains to get from one principal at a time. For instance, one particular principal's network may be down, and that should not affect your business as an entrepreneur. It's just like constraining somebody to own just one account in one particular bank. I don't think that would be good enough for the business of a particular businessman. Now, some of these principals, the compensation plan may be better than the other. And a typical agent is a business person because the money you are investing into the business is your capital, and you expect return on your capital. So you want to be profitable. So if you are constrained to work for one particular principal who is not interested in ensuring that you continue to make the desired profit you expect to make, then that is a problem. Now let's talk about the third one, which is permissible and non-permissible activities. Now, some of the non-permissible activities in this particular circular that was released on the 6th is that agents can no longer open accounts from agent locations. Now, let's think about that. The major essence of financial inclusion is to mass open accounts for so many persons, so many Nigerians, especially where there are no bank locations. How many local governments in Nigeria have bank locations? There are very few of them. Most bank locations are concentrated in the cities, especially the state capitals, and then maybe one or two other commercial towns within the state. So majority of other local government areas don't have bank branches. Now you expect a typical rural dweller to go all the way from the village to the town where these banks are to open accounts. When agents have the flexibility and even now to open accounts and all that, a lot of accounts have been opened in tens of thousands and even hundreds of thousands because agents can go and meet these people in rural places where they are. But with this new circular that account opening is non-permissible in agent location, that's a very big problem. And let me even emphasize this. A lot of agents are already making money from account opening alone. Now, the cash in and cash out activities that is permissible according to this circular now, there is a limit. An agent cannot do more than 1.2 million a day. And the limit does not only apply to the agent, it equally applies to the customer. So a customer cannot do more than 100,000 a day, including bill payments and associated transactions. So let's just do a simple math. If a typical agent can only do 1.2 million a day, and a customer can only do 100,000 a day, which means you can only attend to 12 customers, all things being equal, if each of the customers are withdrawing to the limit. So that is what I mean by this is going to affect a lot of things. Financial inclusion is going to affect the motivation for agents to continue to operate in the agency banking industry, and even the fintechs, the financial institutions themselves as well.
All right, Dr. Oti. All right, Doctor. It does sound like the CBN is going to have a really hard job finding a balance, dealing with the fraudulent activities, and still keeping the financial inclusion drive on. But I mean, we'll continue to talk about it, and I believe that they will get fresh ideas, on how to balance it. So thank you so much for your time on the program this morning. Acting President of the Association of Mobile Money and Bank Agents in Nigeria, AMBAN, Dr. Obioha Oti.
Thank you for having me.
I will take a break now. When we come back, we'll be discussing project management. Have you heard that the cost of building a road in Nigeria is like double what you have next door, Ghana? We'll talk about that and a whole lot more after this break. Please stay with us. Welcome back. Now let's discuss project management, and we've been talking about the infrastructural gap in Africa, in Nigeria, as a deterrent to a whole lot of things. development, logistics, and all. And they say that Africa is home to the world's fastest growing economies, yet that's infrastructural gap, which has been placed at about needs funding of about $170 billion annually to close. Where are we going to get that from? So there was a summit recently, and leaders there agreed that the real challenge is actually not finance, but it is poorly prepared projects. We'll delve into that in a bit, but let's talk about this Nigeria's infrastructural gap and some facts coming out from there. Gap there is about $3 trillion that needs to be spent over the next 30 years if we want to close that gap. 30% of estimated 200,000 kilometers of road are paved. Housing deficit we see is in place at about 28 million units. Less than 16% of road construction projects finished successfully, from reports reaching us between 2000 and 2018. Poor project execution reportedly cost the government an estimated 2 trillion naira. An academic paper also shows that from 2022, that there are 41% of reported public sector projects that were successful based on timelines, budget, and specification. That's 41%, less than 50%. Is it even up to 41%? I wonder. 60% of road construction projects affected by flood-prone areas, they suffer from foundation failures. So shouldn't that have been taken into consideration from the initiation of that? 45% of projects delays in urban areas are linked to pollution-related issues. Let's discuss this here with the Managing Director of Project Management Institute in Sub-Saharan Africa, Mr. George Asamani. Mr. Asamani, good morning and welcome to the program.
Good morning. Thank you for having me, and good morning to the viewers as well. Thank you.
So let me start by asking if you agree that the issue why we have this widening infrastructural gap in Africa, in Nigeria, is not really because of lack of finance, but poor project management.
I think there are several reasons for the infrastructure gap, but definitely one of the reasons why we're struggling from the point of view of infrastructure development is project management capability. And within project management capability, I can tell you that some of our partners who actually fund projects have said specifically, for instance, project preparation is by far one of the most painful areas within the space. And when I say painful areas, what that means is that this is what is not being done, which enables projects, including infrastructure projects, to be successfully run.
So is this because of lack of knowledge, oversight, or some kind of corrupt acts?
It's probably a combination, depending on who's running the project. But when we talk about project preparation, what we're talking about is essentially doing your homework on the project. Because yes, we say that funding may be a challenge, or we're a price-sensitive economy. But actually, there are many projects that have the funds ready. But the people who have those funds, whether we're talking about governments or development banks or companies, they will not release those funds for good reasons, because the project homework hasn't been done. In other words, the project preparation hasn't been done to prove that this is a bankable project. And what that means is in-depth, rigorous analysis on risk management, on financials, making sure that the financials are modeled based on realistic project scenarios. So there's a whole host of critical areas that have to be looked at in a lot of detail before funding can be released and for a project to run successfully. Even if somebody decides to fund a project, a development bank, or whatever the case, if the project preparation hasn't been done well and the project starts, at some point we're going to come into difficulties. That's why you see projects that should be taking 3 years are taking 8 years. Projects that should be building roads or saving, women and children for specific initiatives, those outcomes are not being seen. So project preparation absolutely is a critical part of the challenge at the moment.
So would it be because in the case of public sector for instance, Nigeria, we hear, loans being taken and all of that. And I think the funding is released once the agreement is done. Even if it's being released in tranches, it comes.
Yes.
But sometimes we still don't see the end of those projects. I mean, between 2000 and 2008, just about 41% of projects in Nigeria met the timelines and all of that. And even in some cases, when it seems it's been done, when you talk about sustainability, that paints another picture. We're ahead of flood. These things are supposed, you go to an area and you see a good road, there's no drainage. So that's that's going to be short-lived. Is it the persons involved, or is it, I really don't understand, because do they have the wrong people managing the projects?
That's what that last sentence you said, or that question, is very, very possible, and I'll tell you why. You just said, do they have the wrong people managing the projects? There are 2.6 million people in Sub-Saharan Africa that call themselves a project professional. That's a project manager, project officer, project whatever the case. 2.6 million people. Out of that, less than 5% are actually certified or qualified, and it's closer to about 2 or 3%. So think about it. You have people who will call themselves a project manager managing project. If they're not really qualified or certified, then what does that mean from a project success point of view? So you talked about that road that's been built, the tarmac is there, but the drainage isn't. Potentially, it could be because the wrong people are in place. So that's one of the reasons why PMI, my team specifically, the Africa team, that's why we're absolutely focused on supporting governments, supporting academic institutions and regional bodies, actually to have the right people on projects. So we're all about upskilling the region for that specific reason, to have better, more qualified project managers executing especially these key projects.
So why do I think that qualification is on the one hand, intention is on the other hand? Why do I have that in my head?
Yeah, that's a good question. Hopefully if somebody has invested so much of their time in being qualified, then they will also, of course, have the intention. Because
they want to make quick money. Because you can make quick money and just do whatever you want on the surface and live, even though you're certified.
I think a lot of people are making quick money, and that's why we see that out of everybody who calls themselves a project manager, only a tiny minority are actually qualified. So the quick money people are not investing in themselves to be qualified. The quick money people are just slapping on the label and running projects. And unfortunately, we see the impact of that with project failures or project delays. I think those people who've actually invested invested in themselves properly to be qualified, those are the people who are not only qualified, by paper, but also spend time interacting with community, other project managers, learning, what is the latest, not only local trends, but global trends, keeping up with thought leadership. Those people who invest in themselves comprehensively are running projects better.
So when you talk about this building capacity on the continent, is that the four walls of the school? Is it certificate? Is it, as you said, interaction with the community?
Sure. So when I talk about PMI building capacity in the continent, what I mean is making sure or helping to make sure that we have enough qualified project managers on the continent. What is enough? It's definitely way more than the 2% of everybody who's calling themselves a project manager right now. And how we do that is that we partner with governments, we partner with companies or private sector, partner with academic institutions. So for instance, with government, the intention or the model that we have with government is twofold. First of all, working with government to make sure that people internally within government have the training and the knowledge and the thought leadership on what project management is and the best practice internally within government, because of course they are heavily responsible for a lot of projects in countries and in the region. But outside of government, we also partner with government from a policy development point of view, and also potentially even a pricing and subsidies point of view, so that the general public, there's a way for them, or it becomes easier for them also to gain the skills. Because
you must have had a lot of conversations with Minister David Umahi and WAICA of FCT. These are project men in Nigeria.
That's fantastic. I haven't spoken to them myself. It'll be great to speak with them. And if they're watching, David, I'm looking forward to meeting. But these are people that are key decision makers. These are people who, of course, are making decisions that impact the trajectory of Nigeria. And we're speaking with similar people all across Africa. I just talked about policy. So, for instance, in South Africa, we're partnered with the Ministry of Infrastructure and Public Works, specifically the regulator for construction projects. And we're partnered with them in a way that actually, for anybody to be able to run construction projects in South Africa, they have to be registered with these people who also who use PMI standards.
All right, Mr. George Asamani, thank you so much. Wish you the best.
Thank you.
And of course, the capacity building is very important so that our projects will cost less and last longer.
Absolutely.
It's very necessary. Managing Director, Project Management Institute, Sub-Saharan Africa. Thank you for your time.
Thank you.
We head to the global space. So what's happening right there? Of course, the fight between U.S. and China is on, and China has announced sanctions against 5 U.S.-linked subsidiaries of South Korea shipbuilder Hanwha Ocean amid trade tensions between the world's 2 largest economies, sending the company's shares sharply lower. The move, announced by the Chinese Commerce Ministry, comes on the day that China and the U.S. implement additional port fees targeting each other's vessels, although China has exempted ships that it's built. And still around China, chip-making stocks fell sharply on Tuesday as heightened trade tensions with the U.S. sparked extended profit-taking in the high-flying sector. Markets also grew concerned over increased scrutiny of Chinese companies in the West after reports said that the Dutch government had wrested control of a local chip maker from the Chinese owner. And still connected to the sanctions, but now from Russia, a U.S. sanctioned liquefied natural gas plant in Russia's Arctic region has pressed on with field shipment as Moscow seeks to circumvent Western restrictions and to test President Donald Trump, the Arctic LNG 2 export plant sanctioned by the Biden administration in 2023 after Russia's invasion of Ukraine appears to be loading its 10th shipment since late June. And Google now is saying that they will invest $15 billion over the next 5 years to set up data center capacity for an artificial intelligence hub in India's Andhra Pradesh. The company has said that this marks one of its biggest ever investments in the country. The 1 gigawatt data center campus by Alphabet Incorporated unit will be based in the port city, and officials from the southern Indian states earlier put the investment at $10 billion. The move comes amid intensifying competition among big tech companies, which are spending heavily on building new data center infrastructure to meet booming demand for AI services. And Google alone has committed to spending $85 billion this year to build out data center capacity. We move to the UK now. Growth in British average weekly earnings, excluding bonuses, slowed slightly to 4.7% in the 3 months to August compared with a year earlier. This is according to official national statistics data. Economists polled that they had expected regular annual wage growth of 4.7% for the June to August period, slightly weaker than an increased 4.8% in the 3 months to July. Commodities also affected by all of this. Wheat fell for a 4th day, reaching its lowest level since 2020 on an improved supply outlook and renewed U.S.-China trade tensions. Chicago wheat futures fell to a 5-year low as increasing exports from top shipper Russia raised concerns about abundant global supply. Soybean and corn futures also slipped under pressure from the ongoing U.S. harvest, while soy traders remain unsure whether a potential Washington-Beijing trade deal would revive Chinese purchase of U.S. beans. 1:30 p.m. Then we'll see what's happening with the market. Hopefully, the grain will be sustained in Nigerian stock market. I'm John McWell. I'll talk to you later.